Hello, and thank you for joining us at Parachute Credit Counseling for our virtual education on credit and debt. Today, we'll be talking about credit reports and scores, building or rebuilding credit, and debt management options. My name is Lisa, and I'll be guiding you through the information today. We have three main consumer reporting agencies, also known as credit bureaus. They are TransUnion, Experian, and Equifax. The credit bureau's job is to document your history of borrowing and repaying credit. Everyone is entitled to receive a free copy of your credit report each year from each of the three credit reporting bureaus. The only source that is authorized by federal law to give you these free credit reports is annualcreditreport.com. There may be other free services out there, but you do have to be aware that some companies will want a credit card from you. The free credit report may only be part of a trial. So just beware and bookmark annualcreditreport.com to get that free copy of your credit reports once every year. Another thing to remember is that pulling your own credit report is a soft inquiry, and that means it doesn't hurt your credit score. So never be afraid to pull your own credit report anytime you want to check in on things. Again, that's annualcreditreport.com. You can request your credit report right online through that website, by telephone, or through mail. As far as your credit score goes, a credit score is a numerical number based on the data that is reported on your credit report. So scores typically can range anywhere from 300 to 850. And essentially, a credit score is just estimating you as a credit risk to your lender. They're looking at how you've managed accounts in the past, how you're currently managing your credit. Have you been late? Are you using too much credit? We're going to get in detail in a little bit about how your credit score is made up. But overall, the most widely used credit score by most lenders is a FICO score. There are many different alternative scoring models out there. Even within a FICO score, there are different versions of FICO scores. There's something called a Vantage score. That one's used by Credit Karma, so a lot of people are familiar with that. Or even credit bureau specific credit scores. Different lenders may pull different credit scores or different versions of your score. For example, if you're trying to get an auto loan, there is a specific auto lending credit score that most companies will use. Or it would be different if you were trying to get a mortgage or a credit card or different type of loan. The different scoring models may result in different scores, but it's important to review the actual credit report for accuracy and employ good credit habits going forward to have the best possible score. It can get confusing with all these different versions of credit scores out there. That's why we teach you the basics and tell you to review your actual credit report, because your credit score is developed based off the information contained in your credit report. So as we mentioned, the most widely used version of a credit score is the FICO credit score, and it's made up of 5 components: your payment history, the amount you owe, length of credit history, types of credit used, and new credit. Again, regardless of the scoring model that is being used, these guidelines are good practice. Your payment history is the largest portion of your credit score. It makes up 35% of your total score. The best ways you can improve your credit here are to make sure you're making all of your payments on time, and that's at least the minimum payment due on time 100% of the time. Typically, you cannot be reported late on a credit report. until you're at least 30 days past due and you've missed that second due date. However, again, making your payments on time is a really good habit to develop, just to ensure that nothing gets forgotten or left behind and you don't get a late mark on your credit. Avoiding collection accounts and bankruptcies is also important. These things can stay on your credit report for 7 to 10 years and will have a negative impact on the payment history portion of your credit score. Another thing to consider is that time helps. The longer it's been since the delinquency happened on your credit report, the more your score can improve and the less that delinquency or that negative mark is going to weigh against you. Debt can only be reported to your credit report for 7 years after the account was first reported as delinquent. So negative information will fall off after 7 years. However, making a payment on that delinquent account is going to restart the 7-year clock. Your outstanding debt, or sometimes this section is referred to as your credit utilization, this is 30% of your score. So it's the second biggest factor. This part of your score is looking at not just how much you owe overall, but how much of your available credit you're using. So in this example here, if you have a credit card that has a $10,000 limit, if you start charging more than $3,000, which is 30% of your available credit, your credit score can actually start going down. It does seem a little counterintuitive. You would think if you were given a credit card with a $10,000 limit, you should be able to charge $9,999 and not suffer any negative consequences because you're making your payments on time, you're not going over your credit limit. However, we talked about the fact that your credit score is a measure of risk. So one thing that lenders are going to look at is, are you maxing out your credit cards, or are you not really paying those balances down? You continue to owe a high amount on your cards, and it is more than 30% of your total limit. So if you can leave at least 70% of that available credit unused, meaning you only charge up to 30% of that credit limit, that's going to have you in good shape credit-wise. The less that number is, the better. Ideally, we can all get to a point where we can use our credit cards, pay them in full every month, and not carry a balance, therefore not paying interest. Another part of this is leaving unused accounts open. Your outstanding debt, your credit ratio is looked at not just on your individual accounts, but as all of your accounts as a whole. So all of your credit limits are added up, and then what you owe is taken as an overall ratio as well. So when you're not using a credit card and it has a $0 balance with all of its credit available, leaving it open can actually help that credit utilization percentage overall and help improve your score. Your length of credit history is 15% of your credit score. This also kind of piggybacks off the last thing we said, leaving long-standing accounts open. So not only will leaving those accounts open with a zero balance help your overall credit utilization, it's also going to help your length of credit history. If an account is closed, it's not counted in your overall length of credit history. So keeping longstanding accounts open can show that you've been able to maintain positive relationships and positive statuses on your account over a long period of time. If you do ever need to close an account for any reason, typically it's better to close a more recent credit card and again, leave your longest standing accounts open. And note that how your length of credit history is calculated is actually the average age of all of your accounts. So another tip on this area is not to open a bunch of new credit cards or new accounts unless you really need to. New credit or inquiries is 10% of your credit score. So this is a fairly small portion of your score, but it still counts. You can improve this part of your credit score by having no more than 2 to 3 hard inquiries per year. So what this means is not having opened or even apply for a bunch of new accounts. Please note, though, that if you're shopping for mortgages or for auto loans, if you put those applications in within a 14-day period, it's only going to report as one inquiry or one application on your credit. So we get that little window there to shop around, which is great. Opening several new accounts in a short period of time represents a higher level of risk to lenders. So this also ties into, the length of credit history. If you have a whole bunch of new accounts, that's going to bring your average length of credit history down. So we've mentioned hard inquiries and soft inquiries. A hard inquiry occurs when an application is completed for the purpose of requesting new credit. So when you are applying to try to get something, this will negatively impact your credit score. Those hard inquiries remain on your credit report for 2 years. A soft inquiry is when you request your own credit report, or the request is made to view the credit report for informational purposes only. So, for example, those pre-screened credit offers that come in the mail are soft inquiries. Viewing your own report again, and a credit counseling agency like us here at Parachute, if we're reviewing your credit report with you, it is not going to impact your credit score because we're not a lender. The final 10% of your score is types of credit and use. So this is having a mix of different types of credit. Do you have a loan and a revolving account like a credit card? Now, if you don't have both of these things, don't worry too much. We're not telling you you need to go out and open a credit card if you don't have one, or to get a loan if you don't have one. It's a small portion of your score, but essentially it just helps establish a more comprehensive profile, and again, shown that you can manage different types of debt. So how does your credit score affect you? Really a number of ways. We definitely know that it affects our ability to just obtain credit in the first place, to be able to get approved for things like a car, a credit card, a home, a mortgage loan. But it can also determine the amount you pay for your debt. It determines your interest rates. It can determine your ability to rent an apartment, approval for utilities. A lot of people don't realize it's even factored into the cost of insurance at times. For example, auto insurance typically will look at your credit profile and your score. And there are many employers that also check credit prior to hiring. Sometimes folks will ask why your credit matters for employment. Basically, employers are looking at a few different things. One is to assess your accountability and responsibility. Have you taken care of your outstanding debts? Are you paying on time and consistently? It also can be to check for fraud or other legal or dishonest financial behaviors, or just to simply verify the information that you filled out on your application. Generally, pre-employment credit checks are most common in positions where employees would be dealing with money, financial information, or very sensitive information. So this can influence the financial services sector, banking, government accounts, Department of Defense, or even pharmaceuticals. You always, however, have to provide consent for a potential employer to pull your credit report. So they cannot do it without your consent. However, if you do not consent, that may also exclude you from being considered as a candidate for that job. The higher your credit score is, we know the more likely you will be approved for getting approved for credit for buying and for renting. But additionally, the interest rate will most likely be lower if you have a good credit score. Good credit costs less because of your increased ability to repay and the lower interest rates for borrowing. Bad credit costs more because, you may be considered more risky to these lenders if you have a poor credit score. So they will charge you more in interest rates or fees for borrowing. Or potentially bad credit is if you really don't have the means to repay the loan and to repay that credit back on time. The best way to use actual credit cards to build good credit is really using them only when you have the ability to pay the balance in full each month. So this is the goal we want everyone to get to. But at the very least, even if you can't pay that bill off at the end of the month, just know that you can absolutely afford to make your required monthly payments. For the price of bad credit, it can actually cost a lot. If you don't qualify for a loan, using rent-to-own services for household goods or furniture can actually cost you twice the amount you would normally pay. Those short-term title loans that are out there can end up costing your property if you ever miss payments. And a lot of times lenders can charge excessive fees and interest when your credit score is lower. So if we look at this example here, for a 5-year auto loan for $20,000, if you have a 720 credit score, your interest rate may be around 5 or 6%, your monthly payments $373, and over those 5 years, you pay $2,400 in interest. Versus a credit score of 590, you get approved at an 18.8% interest rate, which bumps your monthly payment up to almost $500. And over that 5 years, you're paying almost $10,000 in additional interest. So again, your credit isn't just, can I get approved or not? It's going to help determine the cost of the money that you borrow. When you carry a balance on a credit card from month to month, as opposed to paying it off in full with each billing statement, the amount of interest can add up to a staggering amount. We have an example here. If you purchase a new living room set for $2,000 on a credit card and only make your minimum payments, it can take up to 25 years to pay that $2,000 off. With interest, you are going to end up paying over $6,000 for that furniture in total. After 25 years, are you still going to even have that living room set? What condition is it going to be in after 24 years? What would its value be? So oftentimes we tell people not to fall in the minimum payment trap. Minimum payments are great and convenient. We're able to borrow larger sums of money on a credit card and not have to pay it all back right away. However, if we only make the minimum payment, we can pay out a lot more and be in debt for a lot longer. So these examples here are based on credit cards with an 18% interest rate, which isn't great, but isn't terrible. It's fairly middle of the road. And if you just make your required minimum payment, which is generally around 2.5% of your balance, $10,000 will take you 29 years to pay off. And you will have paid over $24,000 by the end of it. So again, we oftentimes don't think of these things, but it can be so expensive if we borrow with the plan of only making the minimum monthly payment. Couple credit terms that we think it's important for folks to understand. Introductory or promotional interest is oftentimes where you have either a 0% interest rate or a lower interest rate for a set amount of time. It might be 6 months, it might be a year, it might be 18 months. Be cautious of these 0% or low introductory interest rates. You really need to look at what the interest rate is going to be after that promotion ends. And are you going to be able to pay off that account before the other higher interest rate kicks in? Deferred interest can be even more dangerous. You typically are not paying any interest at all within the first few months. Typically, it might be 6 months or 12 months. but your interest is still accruing monthly. It's just sort of being kept off to the side. If you don't pay that entire balance in full within the deferred interest period of 6 months, in this example, they will actually take all of that interest that had accrued each month and add it on to your balance for you to have to pay back, then start charging you interest on top of all of that. Variable interest rates are also common, especially with credit cards. The interest rate is variable, meaning it can change. So if interest rates go up, you're paying a higher interest rate. If interest rates go down, you would pay a lower interest rate. If you have established credit, but you're struggling to improve your credit score, we'll talk through a few strategies that you can take to help you improve your credit score and hopefully do it a bit more quickly. As we said before, make your payments on time every time. If you ever think you're going to have difficulty making a payment, contact your creditor right away. There may be some help or some sort of program that they can do for you to help you not have a late mark on your credit. Keep that credit utilization under 30%. As we mentioned before, don't charge more than 30% of your credit limit, even if you pay your balances in full each month. The thing is that every lender reports to the credit bureau once every 30 days. So you could be charging your credit card and charging it all the way up to the limit, knowing that you're going to pay that balance in full when the bill comes. The problem is you don't necessarily know what time of month that balance on your credit card is being reported to the credit bureau. So even if you're paying that bill in full every month, it could still look like you are maxing out that credit card. So if you never charge more than that 30% to begin with, you're not going to get yourself in trouble credit-wise. Be strategic about taking on new debt and closing accounts. Avoid too many hard inquiries, too many applications. And again, think twice before closing an old account. It's almost always better to keep it open, even with a zero balance. What we would suggest is trying to use an old account here and there just to keep it open due to activities. So if you have an older credit card and you really don't use it anymore, eventually the lender will most likely close it due to inactivity. This can be after a year, it could be after several years. So what we recommend with your oldest account is try to make a purchase at least once every 6 months. Keep that purchase low, pay off the balance in full when your bill comes so you're not paying any interest, but that'll keep that account active in the lender's system so they are less likely to close it due to inactivity. And regularly monitor your credit report for inaccuracies. As we said, annualcreditreport.com. We can get free copies of our credit reports every single year. If you see anything that doesn't look right, a mistake, an error, you can dispute that through your credit report, and hopefully that will eliminate any negative impact to your credit score from that error. Use your credit strategically and wisely. Don't use your credit cards to supplement your income. Really only use those cards if you know you have the ability to repay. Again, if we can get to a point where we can charge just a little bit each month and pay the balance in full, that's going to be the best use of your credit cards to keep your credit score in good shape. Now, if you have primarily negative information on your credit report, like old collection accounts, or if you have no credit, consider these strategies to help you establish a positive credit history. If you don't have a credit card at all and your credit score is low, a secured credit card is a wonderful option to help you rebuild your credit. A secured credit card is a product that requires you put down an initial deposit. Think of it like a security deposit on an apartment. If you ever, miss payments on your credit card, you fall behind, the bank could essentially keep that initial deposit. So it's easier to get approved for because it's less risky to the lenders. After you make that initial deposit, you are given a credit card that can be used like any other credit card, but it's a short-term tool to help you build up or rebuild your credit if the information is only negative. A lot of times secured credit cards do have fees and higher interest rates, so we recommend just charging a little bit and paying them off in full each month, as we discussed before, but they report to your credit report just like a normal credit card. So if you can't get approved for a traditional credit card, a secured credit card is a lot easier to get and will help you rebuild or build that positive history. There's also credit building loans that can help you build or rebuild. A lot of times these, you see them more commonly offered through credit unions or community banks, but there are online lenders that offer these types of products as well. And the way that a credit building loan works is you typically don't get that chunk of money all at once like you would with a typical loan. You typically are paying monthly payments, but they're going into a savings account. At the end of the loan period, oftentimes 1 year or 2 years, you actually get the balance of that savings account with all your payments that you made in it, but the lender will take interest and fees from that. So that's how they're making money, but you're working to rebuild your credit or to build your credit, and also you get a little bit of savings at the end of it. When you're looking to obtain credit, make sure that you're shopping around. Try to look for something that has the lowest interest rate, no or low annual fees or application fees. A lot of lenders nowadays are offering additional benefits like giving you access to your credit score each month or your credit report. So try to look for those. You definitely want to make sure that lender is reporting to all 3 credit bureaus. That's typically not an issue for most larger lenders. Sometimes smaller banks may be different, so just check. And there are a couple websites here that promote some secured credit cards and other lending products, but you can also always look around yourself, going to different banks' websites, or even just starting with a local bank or credit union in your area. Another method that can help in rebuilding credit is the Experian Boost system. This is a free service Experian offers that allows you to connect your payment history on non-traditional credit, like you paying your electric bill every month or your cell phone bill, and it can help boost your credit score by a few points. The only issue is it's only applicable to Experian. It doesn't impact your Equifax or TransUnion credit scores, but it is something for free that you can do. You never really know which credit report your lender is going to pull. So this is why it's good for Experian, but not for the others. So you may want to employ some of those other techniques that we talked about earlier. If you're curious about ways that you can help your young adults in your life build their credit, there are ways that you can help them. You may be able to add your teenager or young adult child onto your credit card as an authorized user. What happens is, as an authorized user, is that account is going to show up on their credit report as well as yours. So they kind of can benefit from your positive payment history. They don't need to make any charges or access the account. You can give them access to the account. However, they're not legally responsible to pay for anything as an authorized user. You, as the borrower, are responsible for all charges made. So sometimes it's a good idea to just add them as an authorized user, but not actually give them a card. You also could potentially co-sign for a loan or a credit card. It may help them qualify for credit that they otherwise could not get. And that can help, boost up just having, some positive payment history on a loan or credit card. But again, keep in mind that if they're unable to make their payments as a co-signer, you are also legally responsible for that debt, and it will affect your credit report. You can also encourage them to obtain a low limit credit card. the secured credit cards that we talked earlier about. Teach them how it works. Maybe show them this presentation. Encourage minimal and responsible usage of credit cards. If you're ever denied credit, absolutely ask the creditor to be specific on why you were denied. Unspecified or vague reasons for denial are actually illegal. The Equal Credit Opportunity Act gives all of us the right to actually get a free copy of our credit report if we request it upon denial of credit, and to get the reasons why that credit application was denied. So typically you will receive a letter in the mail from a lender if you were declined, and it should give you all the information on why it was denied and also on how to get a free copy of your credit report. Predatory lending is an issue in this world, unfortunately, and predatory lenders sort of prey on people with low credit scores, and they can charge really, really crazy high fees and interest. How to look out for predatory lending? Look for things that have an excessive amount of fees. You know, there might be a prepayment penalty, there might be an application fee, and then a credit report fee. Also, any interest rates that are higher than 30% are considered predatory. Another thing is a balloon payment. You know, say the lender says to you, we're going to give you this 5-year loan for the first 4 years, make low monthly payments, $50 a month, but then at the end of that loan term, you owe the remaining $10,000 in one lump sum, or even prepayment penalties. If anyone's trying to rush you to make a decision or rush you to sign something right away, that's a red flag to watch out for. And never leave things blank on paperwork, or if a lender is asking you to lie on paperwork, these are not good signs. You should walk away and look for a more legitimate deal. If you're sick of receiving all of those pre-approved credit offers in the mail, you can absolutely opt out via this 888 number or going to optoutprescreen.com. If you have if you have relationships with certain lenders already, though, you may need to internally opt out of getting offers. For example, if you bank with ABC Bank, you may continue to receive loan offers or credit card offers from ABC Bank because you have that relationship established with them already. Each lender typically has internal opt-out processes that you can take to stop getting those, but this general opt-out will stop you from the random ones that come. Debt is common. Many of us have it, and there's a lot of different solutions to managing debt and getting out of debt. Every single person out there's financial situation is unique. There's no one-size-fits-all approach, so each situation is going to have its own best solution. But going over some of these main debt solutions that are out there, the first we'll talk about is the power payment method. This is a plan that you administer yourself, and you are repaying your debts by paying accounts with the highest interest rates first and paying more than the minimum payments. You can also order your debts by balance order. So what you do is you would make your minimum payments on all of your accounts. However, the account that has your highest interest rate or your smallest balance, you would pay more on that account. Once that account is paid off, you take the money you were paying to that account and then you apply it to the next one in line, either the next highest interest rate or the next lowest balance. And you can typically get your debts repaid about 3 times as quickly as if you were to just sort of try to, kind of pay as you go. So again, this helps you get out of debt in a shorter period of time, and it saves you interest. The downside of this is that you have to have extra money to work with. You have to be able to make all your minimum payments plus more. You also are going to need to stop using the credit cards in order for this to work. There's also something called a debt management plan, or a DMP. This is where you'd work with a nonprofit credit counseling agency, such as Parachute, such as us, To develop a plan to pay off your unsecured debts like credit cards, personal loans, things like that, in full within 5 years or less. The advantage of a debt management plan are reduced interest rates, one convenient monthly payment. A lot of times it can reduce what you're actually paying out every month, stops late and over limit fees, and it has the potential to increase your credit score over time because you're repaying your debt a lot more quickly. Disadvantages to a debt management plan is that typically lenders will close your accounts when you enroll in a debt management plan because they know you're going into just strict repayment mode. And that can potentially decrease your credit score in the short term, as we talked about earlier. We already talked about that minimum payment trap, right? So when you look at the top of the screen, we see that example we used earlier. Towards the bottom of the screen, we show you those same balances owed, but how it looks on a debt management plan. So again, here at Parachute, we do offer these. So if you were on a debt management plan with us, you know that $10,000 instead of 29 years, it's going to take you 5 years to repay it. You're going to make a total of $11,800 in payments, only pay about $1,800 in interest. So you're saving over $12,000 from just making your minimum payments on your own. So a debt management plan can absolutely help you save money monthly and in the long run and save you a lot of time. Consolidation loans are unsecured loans, so there's no property attached to those loans. That is used to pay off your debt. This also can be considered a personal loan, but typically if you're talking to a lender, you want to let them know it is for the purpose of paying off your debt. The advantage is one convenient monthly payment. You could potentially get lower interest rates on a loan and potentially reduce monthly payments. Disadvantages of consolidation loans is they may be difficult to obtain. It is a credit application, you have to get approved for it, and it could even stretch your repayment period out even longer. But same thing with a home equity loan, or if you were to take a home equity line of credit, let's say, to repay some debt. This is now secured debt, meaning it's attached to your home. Your home is the collateral for that loan. So advantages here is it's probably going to reduce your monthly debt payment because you're stretching it out over 10 or 15 years. And the interest that you pay on that home equity are tax deductible. Disadvantages is that you're converting unsecured debt to secured debt, and that's a heightened risk. With unsecured debt, you could potentially file bankruptcy if all else fails. But if that is attached to your home, things can change with that a bit. Debt settlement is where you can negotiate with the lenders that you owe to settle your debt for less than the full amount owed. So this means where you can potentially offer a lump sum payment. If you owe $5,000, you may be able to say, I can pay you $3,000, and the rest would be forgiven, essentially, or settled. The advantages is that you can pay less and possibly be debt-free in a shorter time frame. The disadvantages are that they typically are only an option if accounts are delinquent or charged off. If you are not delinquent or charged off, to get to the point where you can do a debt settlement means you're going to have to fall behind on your account, which is damaging to your credit. The account is going to reflect as settled rather than paid in full, which is more negative to your credit score. And there's also potential tax implications. If a creditor forgives more than $600 of what you owe, you have to pay income tax on the amount of debt that's forgiven. So it's not a true forgiveness, essentially. And then there's bankruptcy. It's a legal proceeding filed in the United States Bankruptcy Court. The two main chapters most consumers are looking at are Chapter 7, which will permit a complete discharge or liquidation of all of the debt that you include. And Chapter 13 involves a repayment plan of some or all of your debts over a 3 to 5 year period. A bankruptcy can lower your credit score significantly. We're typically looking over 100 points. It can take about 2 to 4 years to repair your credit after a bankruptcy. And that bankruptcy will stay on your credit report for between 7 to 10 years, depending. So we went over all these options, and as we said, every person's situation is unique. So we're here to help. If you want to talk to one of our wonderful financial counselors about your specific situation, all these different options on how to get out of debt, how to improve your credit or build your credit, even how to budget, we offer help on all of these things. Please contact us if you would like that assistance. You can reach out to us by phone, 716-712-2060, and visit us online at parachutecreditcounseling.org. Thank you so much for taking the time today to join us. We look forward to speaking to you soon.